Are you tired of chasing quick profits and getting burned by emotional decisions in the stock market? Imagine if you could approach investing with calm confidence, armed with timeless principles instead of market hype. That's exactly what The Intelligent Investor promises and delivers. First published in 1949, this book is written by none other than Benjamin Graham, widely known as the father of value investing. Graham was more than a brilliant investor. He was also the mentor of legendary billionaire Warren Buffett, who credits this book as by far the best book on investing ever written. Graham's philosophy is grounded in logic, discipline, and the powerful concept of a margin of safety, which helps investors protect themselves against both risk and uncertainty. In this audiobook summary, we'll walk you through each of the book's 20 chapters, chapter by chapter. You'll learn the core difference between investing and speculation, how to think like a defensive versus an enterprising investor, how to analyze stocks rationally, and why your behavior is often more important than your intelligence when it comes to making money in the markets. Whether you're a beginner or a seasoned investor, this summary will equip you with foundational tools to build long-term wealth safely and sensibly. Stay tuned as we dive into one of the most important investment books ever written. This could be the turning point in your financial journey. Chapter 1. Investment versus Speculation. Results to be expected by the intelligent investor. What if the biggest threat to one's financial future isn't the stock market, but the way it is approached? The first essential distinction in building long-term wealth is the difference between investment and speculation. An investment operation is one that, after thorough analysis, promises safety of principal and an adequate return. Anything not meeting these criteria falls under the category of speculation. In today's markets, this line is often blurred. Many individuals participate in the stock market under the belief they are investing, when in reality they are speculating, responding to short-term price movements, trends, or media excitement without a structured approach or adequate research. This confusion leads to unrealistic expectations and ultimately disappointment or loss. The intelligent investor, however, takes a different path. Rather than chasing quick profits, this approach involves calm, calculated decisions rooted in analysis and long-term thinking. Historical performance has shown that such discipline tends to outperform frequent trading or emotional decision-making. Importantly, speculation is not inherently wrong. It may serve a purpose when undertaken consciously and within a limited scope. The risk lies in treating speculation as investment, especially when it dominates one's financial behavior. Without awareness, this can lead to substantial financial vulnerability. What should the intelligent investor realistically expect? Sound investing is not a promise of rapid wealth. Instead, it offers moderate but consistent returns over time, preserving capital and building it gradually. It requires patience, emotional control, and a commitment to avoid the noise of the markets. Markets will always fluctuate, but what remains constant is the tendency of people to overreact, either in fear or in greed. Recognizing this, the intelligent investor chooses discipline over impulse and rational analysis over speculation. In mastering this mindset, one lays the groundwork for financial security and long-term success, achieved not by luck, but by methodical and informed decisions. Chapter 2. The Investor and Inflation. What happens when the purchasing power of money quietly erodes, even while investments appear to grow? Chapter 2 confronts one of the most persistent yet often underestimated threats to long-term wealth: inflation. Unlike market crashes, inflation operates silently, stealing value without immediate notice. For the intelligent investor, understanding and preparing for inflation is a non-negotiable part of investment planning. Historically, investors have relied on bonds and savings accounts to preserve wealth. However, during inflationary periods, the real return on such fixed income assets often turns negative. A bond yielding 4% may seem secure, but if inflation runs at 5%, the investor is effectively losing money in real terms. This erosion becomes more dangerous over long periods, especially for those relying on income from their investments. Stocks, by contrast, have shown some resilience against inflation. Over extended periods, equities tend to outperform bonds because companies can raise prices, grow earnings, and thereby offer some protection against rising costs. However, this does not mean that stocks are a perfect hedge. They can still suffer during bouts of high inflation, especially when combined with economic stagnation. Real estate and tangible assets have also historically been viewed as partial hedges. Yet no asset class is entirely immune. This underscores the importance of diversification, not just across companies or industries, but across asset types that respond differently to inflationary pressures. Perhaps the most crucial takeaway is that inflation should never be ignored, even in periods of apparent economic stability. It is not a theoretical concept, it is a real, historical phenomenon that has eroded fortunes when left unaccounted for. The intelligent investor does not seek to predict inflation, but to prepare for it. This means prioritizing investments that have the potential to grow in real terms, considering inflation-protected securities, and remaining wary of overcommitting to fixed-return instruments in inflationary environments. Preparedness is protection. By acknowledging inflation as a permanent consideration, not a passing phase, the intelligent investor builds a portfolio resilient enough to withstand both visible market shocks and the invisible erosion of purchasing power.
Chapter 3: A Century of Stock Market History. To make sound investment decisions, one must understand the long-term behavior of the stock market. Chapter 3 offers a historical overview of market trends, stretching over more than a century. The goal is not to predict future movements, but to build perspective, something the intelligent investor must always carry. From the early 20th century through the beginning of 1972, the stock market has moved through cycles of prosperity, depression, recovery, and exuberance. Graham reviews key milestones: the boom of the 1920s, the devastating crash of 1929, the prolonged bear market of the 1930s, the recovery in the post-war era, and the volatile 1960s. These events underscore that markets do not rise in a straight line. They're subject to sharp shifts driven by economic, political, and psychological forces. At the beginning of 1972, the Dow Jones Industrial Average stood around 900 points, a number that might seem arbitrary unless viewed in context. The index had touched similar levels in the mid-1960s, reflecting a sideways movement over several years. This plateau challenges the belief that markets always trend upward in the short to medium term. Graham's deeper concern, however, lies in valuation. He emphasizes that the level of stock prices should always be judged against corporate earnings, interest rates, and overall economic conditions. When prices far exceed intrinsic values, investors face greater risk, even if prices continue to rise in the short term. The intelligent investor learns that market history is not a script for future performance, but a reference for caution, balance, and reasonable expectation. Those who study past patterns gain a deeper appreciation for the rhythms of optimism and fear, which so often drive investor behavior more than logic. Importantly, this chapter introduces the idea that overvaluation is just as dangerous as a market crash. Investors must evaluate whether stocks are priced fairly in relation to earnings and dividends, not just chase recent gains. Through this historical lens, Graham encourages discipline. History cannot be ignored. It teaches that emotional decisions and speculative manias come at a high cost. The intelligent investor is not a fortune teller, but a student of market behavior, using history as a compass, not a crystal ball.
Chapter 4: General Portfolio Policy. Imagine building a fortress, not for war, but for wealth. A structure so resilient that it stands firm in storms of market panic, inflation, and economic uncertainty. This is the goal of the defensive investor: to build a portfolio that survives, even thrives under pressure. In this chapter, Graham introduces the concept of the defensive investor, someone who seeks dependable results without the need for constant attention or advanced expertise. This kind of investor isn't chasing market trends or analyzing complex financial statements. Instead, they prioritize stability, consistency, and minimal risk. To achieve this, Graham proposes a straightforward portfolio strategy, a balance between stocks and bonds. A classic allocation, often split 50-50, serves as a foundation. However, depending on market conditions, the investor may adjust, never going below 25% in either category and never exceeding 75%. This flexible framework helps maintain emotional balance and guards against overexposure to market extremes. Why this approach? Because market enthusiasm and pessimism often cloud judgment. During euphoric bull markets, people tend to load up on stocks, ignoring the risks. In bearish downturns, fear pushes them to flee to bonds or cash, missing future recoveries. The defensive portfolio acts as a psychological anchor, protecting against such impulses. When selecting bonds, safety is paramount. Graham favors high-grade, government, or top-rated corporate bonds. These are less exciting, but far more predictable than speculative issues. For stocks, the recommendation is similarly cautious. Large, established dividend-paying companies with a solid record of earnings and growth. The goal isn't to beat the market, it's to avoid being beaten by it. This disciplined portfolio policy ensures that even during times of extreme market volatility, the investor remains protected. The defensive investor may not earn the highest returns in bull markets, but more importantly, they avoid devastating losses in bear markets. Graham's advice is not driven by fear, but by realism. He recognizes that most individuals neither have the time nor the temperament to analyze investments constantly. A defensive strategy frees them from emotional traps and ensures a solid long-term outcome. In essence, this chapter lays the groundwork for conservative wealth building. The intelligent investor, when choosing the defensive path, values peace of mind over performance, and in doing so, often comes out ahead.
Chapter 5: The Defensive Investor and Common Stocks. Common stocks present both an opportunity and a challenge for the defensive investor. The objective is not to maximize returns through speculation, but to include a reasonable equity component that supports long-term growth while preserving peace of mind. This chapter emphasizes the importance of stock ownership within a defensive portfolio, not as a gamble, but as a carefully measured investment. Stocks offer protection against inflation, something fixed income securities like bonds cannot always provide. However, this advantage comes with greater price volatility, something the defensive investor must prepare for mentally and structurally. To navigate this, a disciplined approach to stock selection is essential. The criteria outlined include a company's size and stability, a strong financial position, consistent dividend payments over many years, moderate price-to-earnings ratios, and a reasonable relationship between market price and book value. By using such filters, the investor avoids companies that are risky, overhyped, or poorly managed. Diversification is another key principle. A broad spread of stocks across multiple industries reduces the risk associated with any single firm or sector.
No single holding should dominate the portfolio. This shields the investor from catastrophic losses should an individual company underperform or collapse. It is also recommended that the defensive investor avoid the temptation to chase market fads or buy based on tips. Instead, purchases should be made with logic, evidence, and a long-term mindset. The goal is not to predict short-term movements, but to participate in the overall growth of the economy through ownership of fundamentally sound businesses. Moreover, patience plays a central role. Prices may fluctuate wildly in the short term, but over time, quality stocks tend to reflect the intrinsic strength of the underlying companies. The defensive investor remains grounded, avoiding panic during downturns and euphoria during rallies. This chapter reinforces the idea that stock ownership is appropriate, even necessary for conservative investors, provided the choices are made wisely and the investment is part of a broader, balanced strategy. By avoiding speculation and maintaining a consistent, rule-based approach, the defensive investor secures a valuable stake in economic progress without succumbing to the emotional roller coaster of the market.
Chapter 6. Portfolio Policy for the Enterprising Investor, Negative Approach. While the defensive investor favors stability and minimal effort, the enterprising investor adopts a more active approach. However, this chapter begins not by listing what to pursue, but by highlighting what to avoid. This negative approach is foundational. It prevents wasted energy and costly mistakes by steering the investor away from the seductive traps that frequently lure even the experienced. The enterprising investor, though willing to put in extra work, must not confuse action with progress. Activity for its own sake, chasing hot stocks, responding to rumors, or jumping into poorly understood ventures is discouraged. Instead, the first rule is to avoid obvious pitfalls. Among these are new issues, especially IPOs, high-growth companies at excessive valuations, and the latest market fads. These areas tend to attract speculative interest, and their performance is often erratic or disappointing in the long term. Another category to be cautious of includes secondary companies in overpopular industries. These firms are frequently bid up in price during market enthusiasm, despite weaker fundamentals or questionable long-term prospects. The enterprising investor must resist the temptation to buy merely because a stock is trending or appears frequently in the financial news. Graham stresses the importance of skepticism towards so-called expert recommendations and market predictions. No analyst or investment manager, regardless of reputation, can consistently forecast short-term market movements or identify the next big winner. Instead of seeking shortcuts through speculation, the enterprising investor should cultivate independent judgment and maintain a long-term focus. Overconfidence is also addressed. The moment an investor believes success is inevitable, risks often increase unnoticed. The best safeguard against such overconfidence is humility, recognizing that markets are unpredictable and that even rigorous analysis does not guarantee favorable outcomes. This chapter encourages the enterprising investor to eliminate what doesn't work before seeking what does. A sound investment policy begins by avoiding danger zones, overpriced stocks, untested ventures, and emotionally charged decisions. It is only after these threats are excluded that intelligent, constructive strategies can be pursued. Ultimately, success as an enterprising investor lies not in constant excitement or rapid gains, but in the quiet discipline of avoiding mistakes. By saying no to what is popular but perilous, the investor creates space for opportunities grounded in value, patience, and sound analysis.
Chapter 7. Portfolio Policy for the Enterprising Investor, the Positive Side. After establishing the importance of avoiding common pitfalls,
This chapter shifts to constructive strategies for the enterprising investor, those willing to commit time, discipline, and research to seek above-average returns. The emphasis here is not on high-stakes speculation, but on carefully selected methods that offer potential rewards without compromising the principles of value investing. At the heart of this approach lies security selection. Instead of blindly chasing popular stocks, the enterprising investor focuses on undervalued securities, those selling for less than their intrinsic worth. These may include neglected or temporarily unpopular companies that possess strong fundamentals, solid earnings, and sound financial structures. When the market eventually recognizes their value, they tend to offer satisfying long-term gains. One recommended method is the comparative analysis of individual companies, particularly in the same industry. By examining key financial ratios such as price to earnings, dividend yield, book value, and debt levels, an investor can identify firms that stand out in terms of value and resilience. The goal is to find those whose current price does not reflect their actual earning power or asset base. Another approach involves bargain issues, also known as net stocks, companies trading below their net current asset value. While these opportunities are rare in modern markets, they occasionally appear during economic downturns or in neglected sectors. Though often smaller and less glamorous, such investments can offer a wide margin of safety when chosen wisely. Special situations also offer opportunities. These include corporate restructurings, mergers, spin-offs, or other events likely to unlock shareholder value. However, these scenarios require a deep understanding of the business and close attention to developments, making them suitable only for truly diligent investors. Throughout this chapter, Graham emphasizes the need for patience and emotional control. The enterprising investor must resist the pull of market noise and sensational news. Success is found not in dramatic moves, but in quiet, reasoned decisions backed by analysis and a long-term view. The enterprising investor's path is not for everyone. It demands more involvement, more study, and the ability to act independently. But for those who can meet these standards, the rewards can be greater than those available to the defensive investor, provided the strategies are executed with discipline and care.
Chapter 8. The Investor and Market Fluctuations. Market fluctuations are a fact of life. Prices go up, prices go down, and often not in line with underlying values. In this chapter, Graham introduces one of his most enduring lessons. Market volatility is not an enemy to fear, but a tool to understand and potentially benefit from. Rather than being led by the whims of the market, the intelligent investor uses these fluctuations to his or her advantage. The central message is clear. Investors should not view the market as a guide, but as a servant. It exists to provide opportunities, not to dictate behavior. To illustrate this principle, Graham famously introduces the parable of Mr. Market, a hypothetical business partner who offers to buy or sell shares of your business each day. Sometimes, Mr. Market is exuberant and offers high prices. Other times, he's despondent and offers prices far below value. The key is to recognize that Mr. Market's mood is not your concern. Your job is to assess whether his price is attractive based on your own judgment. This chapter outlines two main strategies for responding to market movements. The defensive investor, who should be largely indifferent to short-term market swings. This investor focuses on the long-term performance of sound, diversified holdings. Rather than trying to time entries and exits, the defensive investor maintains discipline, rebalances periodically, and avoids emotional reactions. The enterprising investor, on the other hand, may choose to actively respond to market fluctuations by buying when others are fearful and selling when others are greedy. But even this approach is grounded in logic and valuation, not in prediction. The enterprising investor must rely on thorough analysis and a margin of safety, not market momentum. One of the most important themes in this chapter is emotional discipline. Market swings can stir fear and greed, two powerful forces that can lead to poor decisions. The intelligent investor learns to remain rational and objective, seizing opportunities when prices are low and showing restraint when prices are irrationally high. Ultimately, Chapter 8 offers a timeless mindset. Volatility is not a threat, but an opportunity. The wise investor does not try to outguess the market, but instead uses its fluctuations as a means to buy value cheaply and to hold with confidence during uncertain times.
Chapter 9. Investing in Investment Funds. In Chapter 9, Graham turns his attention to a popular option for investors who prefer a more hands-off approach: investment funds, particularly mutual funds. These funds pool money from many investors to buy a diversified portfolio of stocks and bonds, offering convenience, diversification, and professional management. But convenience should never replace critical thinking. Graham emphasizes that not all investment funds are created equal, and investors must be cautious when selecting where to place their money. One of the key distinctions Graham makes is between actively managed funds and passively managed funds. Actively managed funds are overseen by fund managers who make decisions on what securities to buy and sell, aiming to outperform the market. Passive funds, on the other hand, aim to replicate the performance of a market index, like the S&P 500. Graham questions whether the majority of active managers consistently deliver better than average results, especially after accounting for fees and expenses. He observes that most mutual funds fail to outperform the market over the long term, largely due to management costs, sales charges, and poor timing decisions. He advises the defensive investor to be particularly wary of marketing claims and short-term performance metrics. Past success does not guarantee future returns. Instead, he encourages investors to look for funds with low operating expenses, long-term consistency rather than sudden gains, a conservative investment style, and honest and transparent reporting. Graham also reminds readers to consider closed-end funds, which trade like stocks and can sometimes be bought at a discount to their net asset value. These may offer a value opportunity, provided the investor performs due diligence. Ultimately, the intelligent investor should treat fund investing with the same discipline and skepticism applied to individual securities. Blindly trusting a fund manager or chasing last year's top performer often leads to disappointment. Discipline, research, and cost awareness remain crucial even when delegating portfolio management to a fund. This chapter underscores a core theme of the book: the importance of investor behavior. Whether managing one's own portfolio or investing through funds, success depends more on temperament and judgment than on chasing trends or flashy returns.
Chapter 10. The Investor and His Advisors. In the complex world of investing, the role of a financial advisor can appear both essential and ambiguous. Chapter 10 explores the value, limitations, and expectations surrounding professional financial guidance, offering a clear-eyed view of what investors should know before seeking or relying on expert help. Financial advisors can serve various functions, from portfolio management to emotional coaching. However, their competence, honesty, and alignment with client goals are not guaranteed. It is crucial for investors to approach this relationship with a mix of openness and critical thinking. One of the key concerns is the misalignment of incentives. Many advisors earn commissions based on selling financial products rather than the long-term success of the investor. This often leads to conflicts of interest, where recommendations may prioritize profit for the advisor over value for the client. Investors are advised to evaluate advisors not just by their confidence or marketing prowess, but by their track record, transparency, and investment philosophy. A good advisor should educate the client,
encourage long-term thinking, and help maintain discipline, especially during periods of market euphoria or panic. Technical expertise is important, but it's not everything. Qualities such as patience, prudence, and consistency often matter more in the long run. An effective advisor doesn't promise to beat the market, but focuses on crafting a sound strategy tailored to the investor's risk tolerance and financial goals. Advisors should also help protect investors from themselves. Emotional decision-making, fueled by fear, greed, or media hype, often leads to poor outcomes. A disciplined advisor can act as a stabilizing force, reminding clients of their long-term objectives and dissuading them from rash moves during market turbulence. Finally, while many individuals are capable of managing their own investments, some level of guidance can still be beneficial, especially for those who lack the time, experience, or confidence to go it alone. However, that guidance must be earned, not assumed. Chapter 10 emphasizes the importance of choosing financial advisors with care. The intelligent investor remains responsible for their financial destiny, even when working with professionals. Blind trust is never a substitute for personal accountability and informed decision-making. Chapter 11. Security Analysis for the Lay Investor. General Approach. Chapter 11 introduces the fundamentals of security analysis for non-professionals, an essential skill for anyone aiming to invest intelligently rather than speculate blindly. It offers a practical framework for evaluating individual stocks, ensuring that investment decisions are based on sound reasoning rather than emotion or hype. At its core, security analysis is the process of determining the value of a stock relative to its current price. This isn't about predicting market trends or chasing short-term gains. Instead, it involves evaluating the financial condition, performance history, and future prospects of a company with an eye toward long-term returns. The chapter encourages investors to focus on three major factors when analyzing a security: the company's general financial position. This includes its balance sheet strength, liquidity, and debt levels. Companies with excessive debt or poor cash flow are riskier and more vulnerable during economic downturns. Its quality of earnings. Investors should assess whether reported profits are stable, growing, and backed by actual cash flows. High variability or dependence on unusual or non-recurring gains is a red flag. The outlook for the business. While predicting the future is inherently uncertain, it is still important to understand a company's industry, competitive position, and the potential challenges it may face over time. Importantly, Graham stresses that no single formula or tool guarantees success. Valuation involves both quantitative and qualitative judgment. However, lay investors are advised to avoid complexity and stick with companies they understand, preferably those with long records of stable earnings and conservative financial policies. This chapter also introduces the idea of a margin of safety, where investors seek to buy stocks at a price significantly below their intrinsic value. This buffer protects against errors in judgment, unforeseen developments, or market fluctuations. For most investors, extensive analysis may not be practical. In such cases, sticking to well-established, financially sound companies and diversifying across industries can serve as a practical compromise. The emphasis is not on finding the perfect stock, but on avoiding bad decisions through rational analysis and disciplined criteria. Ultimately, Chapter 11 highlights that security analysis doesn't require genius, only a logical, consistent approach. The intelligent investor applies patience and prudence, always grounding decisions in facts rather than speculation.
Chapter 12.
Things to consider about per-share earnings. Per-share earnings are often seen as the most straightforward indicator of a company's performance. However, relying solely on this figure can be misleading. This section urges investors to approach earnings data with critical thinking, recognizing the various factors that can distort or exaggerate what these numbers truly represent. Reported earnings per share, or EPS, are not always a pure reflection of business strength. Many elements can influence them, such as changes in accounting methods, non-recurring items, or corporate actions like stock buybacks. These adjustments may inflate or obscure the actual profitability of a company. Therefore, investors are advised to distinguish between operating earnings and accounting earnings. An important point is that earnings are only meaningful when viewed over time, not in isolation. 1 year of high earnings might result from an unusual event, while a longer-term pattern offers a more accurate picture of business stability and performance. Investors should therefore look at multi-year averages and assess consistency rather than being swayed by a single strong or weak year. There is also the issue of earnings manipulation. Corporate managements, driven by the desire to meet market expectations or boost stock prices, may engage in earnings smoothing or timing strategies. For instance, they might delay expenses or accelerate revenues to create the illusion of steady growth. Thus, investors need to dig deeper into financial statements and footnotes, paying attention to the quality, not just the quantity, of reported profits. Additionally, companies with complex structures or those heavily involved in acquisitions can present earnings that are difficult to evaluate. In such cases, focusing on cash flow or using alternative metrics like owner earnings can offer a clearer perspective. Investors should be cautious about overemphasizing earnings per share, especially if they're being used as the sole justification for a stock's valuation. Ultimately, sound investment decisions require looking beyond surface-level figures. A careful, disciplined examination of how earnings are derived and how reliable they are protects against errors in judgment. True financial strength is best revealed not just by the numbers reported, but by their consistency, transparency, and connection to underlying business reality. Chapter 13. A comparison of 4 listed companies. In evaluating investments, real-world examples serve as a practical lens through which principles can be tested. This chapter presents a side-by-side comparison of 4 publicly traded companies to highlight the challenges and nuances of stock selection. The focus is not merely on identifying the most successful company, but on assessing the investment soundness of each based on measurable criteria like earnings history, financial stability, dividend record, and price relative to value. Each company, while reputable and profitable, exhibits varying degrees of risk and long-term appeal. The analysis underscores that strong earnings alone are not enough. They must be consistent and paired with a reasonable stock price. Some companies might show rapid earnings growth, but if their stock is priced far above its intrinsic value, the investment becomes speculative. Others might appear modest in performance but offer better protection and steadiness over time. The analysis encourages investors to move beyond surface metrics, such as recent profitability or market buzz. Instead, it recommends a structured approach. Examine 10-year financial records, evaluate dividend policies, and consider balance sheet strength. A stock should be judged not by its popularity or price momentum, but by its fundamentals and alignment with the investor's goals, whether conservative or enterprising. An essential lesson here is that the quality of a company is not always reflected in its current market price. A glamorous stock might disappoint due to its inflated valuation, while a less prominent one may deliver superior returns with less volatility. Patience, discipline, and critical analysis
help investors avoid being swayed by trends and focus instead on long-term performance indicators. Through this comparison, the chapter illustrates that investment success lies not in picking winners, but in avoiding overvaluation and emotional decision-making. The intelligent investor learns to distinguish between growth that is supported by solid foundations and hype-driven optimism. The objective is to develop a mindset rooted in evidence, not excitement.
Chapter 13: A Comparison of 4 Listed Companies. In evaluating investments, real-world examples serve as a practical lens through which principles can be tested. This chapter presents a side-by-side comparison of 4 publicly traded companies to highlight the challenges and nuances of stock selection. The focus is not merely on identifying the most successful company, but on assessing the investment soundness of each based on measurable criteria like earnings history, financial stability, dividend record, and price relative to value. Each company, while reputable and profitable, exhibits varying degrees of risk and long-term appeal. The analysis underscores that strong earnings alone are not enough. They must be consistent and paired with a reasonable stock price. Some companies might show rapid earnings growth, but if their stock is priced far above its intrinsic value, the investment becomes speculative. Others might appear modest in performance, but offer better protection and steadiness over time. The analysis encourages investors to move beyond surface metrics such as recent profitability or market buzz. Instead, it recommends a structured approach. Examine 10-year financial records, evaluate dividend policies, and consider balance sheet strength. A stock should be judged not by its popularity or price momentum, but by its fundamentals and alignment with the investor's goals, whether conservative or enterprising. An essential lesson here is that the quality of a company is not always reflected in its current market price. A glamorous stock might disappoint due to its inflated valuation, while a less prominent one may deliver superior returns with less volatility. Patience, discipline, and critical analysis help investors avoid being swayed by trends and focus instead on long-term performance indicators. Through these case studies, the chapter illustrates that investment success lies not in picking winners, but in avoiding overvaluation and emotional decision-making. The intelligent investor learns to distinguish between growth that is supported by solid foundations and hype-driven optimism. The objective is to develop a mindset rooted in evidence, not excitement.
Chapter 14: Stock Selection for the Defensive Investor. The art of selecting stocks for the defensive investor centers on one core idea: minimizing risk while preserving reasonable returns. This chapter outlines a clear and systematic approach that helps the defensive investor avoid speculation and emotional investing, relying instead on consistency, quality, and discipline. A defensive investor is one who prefers safety over excitement and stability over aggressive growth. To serve this purpose, a strict selection framework is proposed. First and foremost, companies must be large, prominent, and financially sound. This means a strong balance sheet, a history of profitability, and a conservative capital structure. Large enterprises tend to weather economic storms better than smaller, more volatile firms. Secondly, the company must have a long record of stable earnings, at least 10 years of consistent profitability, preferably without significant losses, serves as a foundation for trust in the company's long-term prospects. These are not just financial figures. They reflect managerial discipline and operational resilience. Another essential filter is the company's dividend history. A continuous payment of dividends for 2 decades or more reflects not just profitability, but a commitment to sharing returns with shareholders. Dividends act as a cushion against market volatility and ensure that investors benefit even during slow market periods. The price-to-earnings ratio and price-to-book value are also important considerations. The investor should avoid overpaying for even the highest quality stocks. The P/E ratio should be moderate, ideally not exceeding 15 times average earnings, and the price should not exceed 1.5 times the book value. However, these two criteria can be balanced. If one metric is low, the other may be slightly higher. By applying these filters with patience and discipline, the defensive investor can create a portfolio that is resilient and sustainable. This is not about chasing market highs or the next big opportunity. Rather, it's about owning a selection of reliable companies bought at sensible prices, allowing for peace of mind and satisfactory long-term returns. Ultimately, this approach protects investors from the dangers of speculation and market timing. It promotes rational decisions based on tangible data, insulating the investor from the emotional swings of the marketplace.
Chapter 15. Stock Selection for the Enterprising Investor. The enterprising investor seeks greater returns than the defensive investor, but with that goal comes the responsibility of deeper research, more active involvement, and a greater tolerance for short-term fluctuations. This chapter lays out a disciplined strategy for those willing to put in the effort to outperform the market without crossing into reckless speculation. Unlike the defensive approach, which emphasizes broad stability and minimal maintenance, the enterprising strategy allows for selective boldness, provided it is backed by careful analysis and a margin of safety. The foundation remains the same: investing, not speculating. But the execution differs in the selection of undervalued or overlooked securities with strong potential for appreciation. Several avenues are presented for the enterprising investor. One method is to identify undervalued stocks of smaller companies that may not attract institutional investors. These stocks often carry more risk, but can offer significant upside if the underlying business is sound and the market has priced them irrationally low. Another tactic is to seek out bargain issues, such as net stocks, companies selling for less than their net current assets alone. Though rare, these opportunities can offer strong returns when market pessimism is overdone and liquidation value exceeds the stock price. Special situations also come into play, such as companies undergoing mergers, restructurings, or spin-offs. These scenarios require close study and timely action, but they can yield attractive rewards when the investor understands the underlying dynamics. The chapter warns, however, against the temptation to chase growth without regard to value. Even enterprising investors must insist on a margin of safety. Stocks should not be purchased purely on hopes of higher future earnings, especially when priced aggressively. A solid balance sheet, reasonable valuation, and evidence of competent management remain essential filters. Moreover, emotional discipline remains just as vital here as in defensive investing. The enterprising investor must avoid being swayed by market trends, tips, or short-term performance. Instead, consistent principles, thorough research, and a long-term perspective are the pillars of success. In essence, stock selection for the enterprising investor is a blend of courage and caution, analysis and judgment. It rewards diligence, not impulsiveness, and promises not quick riches, but a measured path to above-average results.
Chapter 16. Convertible Issues and Warrants. Convertible issues and warrants occupy a unique space in the investment world, blending characteristics of both equity and debt, and offering investors potential upside with some degree of downside protection. This chapter examines their structure, purpose, and the risks they carry, especially from the standpoint of a conservative investor. Convertible securities, such as convertible bonds or preferred stocks, allow the holder to exchange the instrument for a specified number of common shares, typically at the investor's discretion. These instruments appeal to investors seeking fixed income with the added opportunity to participate in a company's growth. When the stock price rises above the conversion price, the convertible becomes more valuable, aligning the investor's interests with the company's performance. However, the chapter warns that many convertibles are not always issued to benefit the investor. Often, companies use them to raise capital without immediately diluting their common equity. While this seems like a win-win on the surface, it can result in investors overpaying for potential future equity, especially if the conversion terms are unattractive or the company's credit quality is weak. The value of a convertible is largely influenced by the price and volatility of the underlying common stock. This makes them sensitive to market sentiment, interest rate changes, and corporate fundamentals. Yet, the fixed income nature of these instruments can offer some buffer against losses, though not always sufficient protection in declining markets. Warrants, by contrast, are long-term options that give the holder the right, but not the obligation, to purchase stock at a predetermined price. Unlike convertibles, warrants do not pay interest or dividends. Their value is purely speculative and can diminish over time if the stock fails to rise above the exercise price. They are frequently issued as sweeteners alongside other securities to make a deal more attractive. For the intelligent investor, both convertibles and warrants warrant a cautious approach. While some may offer attractive terms and genuine value, many are priced with optimism already baked in. They should never be purchased without a clear understanding of their mechanics, conversion terms, and the financial stability of the issuing company. The core message remains consistent. Only invest in what you understand. Convertibles and warrants can serve as useful tools, but only when their risks are clearly measured and their benefits outweigh the speculative elements.
Chapter 17. 4 extremely instructive case histories and more. This chapter explores the practical application of investment principles through real-world examples. By examining 4 detailed case histories, it becomes evident how fundamental analysis, psychological discipline, and valuation metrics either contribute to investment success or result in costly mistakes. The first case presents a company whose rapid growth and aggressive expansion led to investor enthusiasm, but ultimately collapsed under the weight of poor financial management. Despite rising revenues, the firm took on excessive debt, and its stock price declined significantly. This case emphasizes the importance of analyzing a company's balance sheet, not just its income statement, and exercising skepticism when growth outpaces financial stability. The second case focuses on a company that appeared undervalued by conventional standards. Investors who applied a margin of safety approach, emphasizing intrinsic value, were rewarded when the market eventually corrected its pricing. This history demonstrates how patience and fundamental valuation can reveal long-term opportunities, even in the face of short-term underperformance. The third example involves a firm whose earnings were inconsistent and whose management issued overly optimistic forecasts. Investors who relied heavily on these forward-looking statements faced significant losses. The lesson here is to remain anchored in verifiable data and to be wary of speculative projections, no matter how compelling they may seem. The fourth case illustrates the pitfalls of emotional investing. During a market boom, a company's stock soared, driven by investor euphoria. However, when sentiment reversed, the stock plummeted. Investors who lacked discipline and bought into the hype suffered substantial losses. This example highlights the need for emotional restraint,
especially in periods of extreme optimism or pessimism. These case studies collectively reinforce several core principles: the importance of intrinsic value, the need for conservative assumptions, and the benefit of maintaining a rational, non-emotional approach to investing. The most successful investors are those who remain disciplined, focus on long-term fundamentals, and avoid chasing speculative trends. While each company's story is unique, the underlying themes remain the same. Markets are often inefficient, and investor behavior plays a significant role in shaping outcomes. These histories serve as reminders that sound investment decisions are built not on forecasts or fads, but on diligent analysis, patience, and risk awareness.
Chapter 18. A comparison of 8 pairs of companies. This chapter provides a side-by-side comparison of 8 distinct pairs of companies, each selected to illustrate the differences between sound investment choices and more speculative alternatives. The aim is to equip the reader with a clearer understanding of how to distinguish between fundamentally solid businesses and those that may appear promising but carry hidden risks. Each pair includes one company with strong financials, conservative accounting practices, and consistent performance, and another that either underperforms or engages in aggressive financial behavior. By analyzing these contrasts, the chapter reveals how surface-level indicators can often be misleading and why deeper scrutiny is essential. For example, in one comparison, 2 companies operating in the same industry are reviewed. While both exhibit similar sales growth, only one maintains a healthy profit margin and avoids excessive debt. The other, despite similar market enthusiasm, reveals questionable accounting tactics and an over-reliance on borrowed capital. Over time, the more stable firm provides better returns with lower risk, while the other becomes vulnerable to market downturns. Another pair demonstrates the contrast between a firm that reinvests profits wisely and one that pursues acquisitions to boost short-term results. The disciplined company builds sustainable value, while the other faces integration challenges and mounting goodwill that erodes long-term performance. Other pairs highlight the risks of investing in companies with overly ambitious forecasts, volatile earnings, or speculative market appeal. In each case, the financially disciplined company, marked by stable earnings, low debt, and realistic growth expectations, proves to be the superior choice over time. The overarching lesson is the value of comparative analysis. Evaluating businesses in relation to similar firms helps strip away hype and reveal underlying strength or weakness. It trains investors to ask the right questions. Are profits consistent? Is debt manageable? Is growth organic or forced? Does the company treat shareholders equitably? Ultimately, this chapter teaches that true investment strength is rooted in fundamentals. Market popularity or media attention should never replace financial clarity and prudent management. By focusing on objective comparisons, investors can avoid being swayed by trends and instead make choices grounded in logic, evidence, and long-term viability.
Chapter 19. Shareholders and Management. Dividend Policy. Dividends have long been a foundational aspect of investment returns, offering shareholders a direct reward from a company's profits. This chapter explores the complex relationship between shareholders and corporate management, focusing on how dividend policy reflects a company's financial discipline, transparency, and respect for its owners. At the heart of the discussion is a central question: should companies distribute profits to shareholders or retain earnings for growth and expansion? There is no one-size-fits-all answer. Rather, the decision hinges on a company's maturity, profitability, capital needs, and track record in deploying retained earnings productively. For established firms with steady cash flow and limited growth prospects, Regular dividends are a signal of strength. They reflect management's recognition that shareholders deserve a return and that the company does not need to hoard capital unnecessarily. In contrast, younger or fast-growing companies may retain earnings to fund innovation, expansion, or strategic investments, ideally to generate greater returns over time. However, the chapter cautions against companies that withhold dividends under the pretense of reinvestment but fail to deliver improved earnings or shareholder value. Retaining profits must be justified by actual performance. A company that habitually retains earnings without visible benefits raises concerns about management's motives, priorities, or competence. Another critical aspect discussed is transparency. Investors are encouraged to scrutinize not just whether dividends are paid, but how dividend policy is communicated. Companies that clearly explain their decisions and demonstrate consistency over time tend to command greater trust. Sudden changes in dividend practices without sound justification can erode investor confidence. The chapter also touches on shareholder rights. Investors should not view themselves as passive recipients of whatever a company chooses to offer. Instead, they are partial owners with the right to expect accountability and fair treatment. This includes the right to question management decisions, especially when those decisions involve significant capital allocation. In summary, dividend policy serves as a window into a company's financial health and governance practices. Wise investors pay close attention to how earnings are handled and whether management acts in the best interest of shareholders. A responsible dividend strategy aligned with the company's goals and shareholder expectations is a hallmark of intelligent investment.
Chapter 20. Margin of safety as the central concept of investing. The concept of a margin of safety stands as the cornerstone of sound investing. It refers to the principle of purchasing securities at a significant discount to their intrinsic value. This buffer serves as protection against errors in judgment, unforeseen market fluctuations, or deteriorating business conditions. Just as a bridge is built to carry far more weight than it ever realistically needs to bear, intelligent investing requires a similar level of prudence. The margin of safety ensures that even if the investor's assumptions are slightly off, the risk of permanent loss remains minimized. This is not speculation. It is disciplined risk management. The margin of safety is most evident in value investing. When securities are purchased at prices well below their estimated true worth, the potential downside is limited, while the upside remains substantial. For example, buying a company whose assets, earnings power, and stability suggest a value of $50 per share, but whose market price is $30, creates a margin of safety that cushions the investment. Importantly, the margin of safety does not guarantee profits. Rather, it reduces the likelihood of significant losses. It is a tool for risk reduction, not a promise of reward. This approach requires patience, discipline, and the ability to resist market noise. It also demands thorough analysis to determine a reasonable estimate of a stock's intrinsic value in the first place. The principle applies not only to stocks, but to all forms of investing: bonds, real estate, and even business decisions. Whenever a decision is made under uncertain conditions, a margin of safety helps absorb the impact of unpredictability. Moreover, the margin of safety aligns with conservative thinking. It encourages a mindset that prioritizes capital preservation before capital appreciation. Investors who apply this principle consistently are less likely to fall prey to speculation, hype, or emotional decision-making. Ultimately, the margin of safety is not just a technique, it is a philosophy. It reflects an investor's recognition of the limits of knowledge, the unpredictability of markets, and the wisdom of acting cautiously when the future is uncertain. It is this concept, more than any other, that separates intelligent investing from reckless speculation. Conclusion: the enduring wisdom of intelligent investing. The journey through the intelligent investor is not merely a lesson in stock market strategy, it is an education in discipline, temperament, and timeless financial wisdom. The core message is clear. Successful investing is not about quick profits or speculative brilliance, but about sound judgment, long-term perspective, and risk control. Each chapter reveals that the real strength of an investor lies not in forecasting market trends, but in cultivating patience, clarity, and rationality. Whether through the distinction between investment and speculation, the strategy of stock selection, or the unwavering emphasis on the margin of safety, this book provides a blueprint for approaching financial markets with confidence and care. Perhaps most importantly, the book teaches that one's greatest ally is not a complex algorithm or insider knowledge, but a calm and thoughtful mind. In a world where volatility and emotion often rule the day, the intelligent investor stands firm, not because of luck, but because of preparation, insight, and self-control. Investing at its best is not about excitement or rapid gain. It is about building wealth slowly, securely, and sustainably. And for those who are willing to adopt the principles outlined here, the reward is not just financial stability, but the peace of mind that comes from knowing each decision rests on a foundation of logic and integrity. Now that you've unlocked the principles of the intelligent investor, take the next step with conviction. Let discipline be your compass and knowledge your shield. Start small, but think big. Build habits that reflect patience, not panic. Focus on value, not noise. You don't need to predict the future, you only need to prepare for it. Stay consistent, stay curious, and stay intelligent in every financial decision you make. Whether markets rise or fall, let your strategy be rooted in sound principles. Because in the end, true wealth isn't just about what you earn, it's about what you understand, protect, and grow wisely. Are you ready to think and act like an intelligent investor?